Welcome to our training module about paying overseas for a growing business and how to stop losing money on FX and payments. Although less than 20% of small businesses trade internationally, in terms of absolute numbers, they vastly outnumber their larger competitors. 95% of UK businesses that trade internationally have a turnover of less than 10 million. A similar proportion of EU importers employ less than 50 people. However, while larger competitors have access to solutions that help them manage cross-border payments efficiently, most SMEs don't. This leaves many at a competitive disadvantage. Some never grow big enough to access the right solutions. And it's not just a technology problem. Lacking experience in these areas could also make any growing business vulnerable. For those regularly paying foreign invoices, there are a few things to consider in order to save substantial time and money. Choose the most suitable payment method. Automate time-consuming manual processes. Prevent manual errors and fraud. And avoid currency losses and unnecessary costs. This module explains how to avoid common mistakes and challenges when planning and managing invoices or payroll and domestic and international payments. Depending on the frequency and volume of payments, choosing a suitable payment method can save a business several % in payment and FX fees. Card payments and PayPal are convenient for small and frequent transactions, but are expensive for larger ones. Bank transfers remain popular for larger amounts, where security trumps convenience, but sending SWIFT transfers may be an expensive option for small-value payments. If you have to pay $15 or more for each international transfer each time, it can quickly add up and cost several % for smaller transfers. As a result, a growing number of startups and small businesses turn to more innovative payment providers and fintechs. These providers offer new solutions such as account-to-account payments and access to local payment schemes, which can be attractive options for a broad range of use cases. Equally importantly, many banks and payment providers hide their FX fees in the small print. Credit card providers and PayPal, Stripe or Amazon charge the highest conversion fees, often in excess of 3%. Most large UK banks quote their business customers' exchange rates with 2 to 2.75% markup by default. This topic will be covered in greater detail later in this section. Time-consuming manual processes can really slow your finance team down. Yet preparing, approving, paying and reconciling international invoices remain manual tasks for many growing businesses. Invoices in multiple currencies can be harder to process as they involve dealing with foreign exchange rates, tax rates, and other complications. Manual approvals are easy when you have a few invoices, but quickly become challenging as your volumes grow. Very few banks offer their business customers the ability to synchronize bills to pay in multiple currencies, leaving finance and accounts managers to create payment templates and upload payment files manually. These processes are error-prone and less secure. A quick reconciliation that is often required to make managing finances more robust is also overly time-consuming if you have to enter payments into your ledger and reconcile against invoices manually. If a business finance team processes many invoices, it should consider implementing multi-currency AP automation software. New technologies help address the pain points that were mentioned earlier. OCR, or optical character recognition, combined with machine learning, can help you prepare invoices faster and reduce manual input errors. A robust, role-based approval process can help automate more trivial approvals while streamlining the process for more critical items that require review and approval from authorized individuals. Payment runs in multiple currencies can make processing your payments much faster and more secure. And lastly, two-way API connectivity with your ERP or accounting software can save hours on bookkeeping and reconciliations and help you close month-end a lot faster. According to the research by Aberdeen Group, AP automation can result in average savings of 49% in invoice processing costs and enable the team to process 4 times more invoices with the same staff. Preventing manual errors and fraud is becoming more and more important. This is because typical costs of payment and FX transactions for growing businesses are high, but they can pale in comparison with potential losses from erroneous or fraudulent payments. Cross-border payments are notoriously prone to delays and mistakes as they typically require extra information. Sending funds to the wrong account is difficult to reverse for international payments and often requires the cooperation of intermediary and recipient banks and sometimes the beneficiary. Fraud, such as authorized push payments fraud, as well as account takeover fraud, has become a business pandemic for growing businesses that have embraced remote and online banking. This adds to the list of potential risks that businesses face when paying domestically or overseas, such as the risk of internal fraudulent activity. There are several steps you can take to reduce these risks. First, leverage tools such as confirmation or verification of payee to check recipient details before you make any payment. Available for domestic payments in the UK and soon in Europe, these checks allow you to verify if a recipient account and name match to what you expect them to be. Although these checks are not yet widely available for transfers overseas, innovative solutions such as HedgeFlows have started offering such checks for international transfers. Second, ensure you only use providers that support multi-factor authentication, also known as strong customer authentication. This is a regulatory requirement in the UK and Europe and is designed to reduce the risks of cyber fraud, such as account takeover. Unfortunately, even these tools are not enough to prevent all fraud. Thus, it is essential to invest in robust review and approval processes and fraud detection software that can further help prevent these risks. Managing currency costs and risks can mean different things depending on a company's size and complexity. In this module, managing foreign currencies covers a broad range of objectives, including 1. Keeping finances simple, 2. Managing overall costs, and 3. Improving the stability of profits or cash flows. If one aspect could be changed in how foreign invoices and bills are managed in your business and payments are made between international suppliers and buyers, what would it be? 9 out of 10 growing businesses usually say they would like to trade more internationally, but would ideally manage all their finances in their home currency. So why do most people want to just trade in their home currency if given a choice? It's because when they operate in foreign currencies today, they have to perform routines that are seen as a hassle. These are some examples that have become invisible chores for thousands of small business owners and their finance teams who have to manage foreign currencies around the world. Pricing in foreign currencies, updating and communicating exchange rates to commercial teams so they can quote competitive prices. Protecting from currency losses, deciding how much to pad internal exchange rates to cushion potential currency costs. Reconciling the difference between expected and realized values of foreign orders and invoices. Asking several competing providers for quotes to get a fair exchange rate. Constantly watching exchange rates to make sure the business does not lose out because of fluctuations. If any of the above sounds familiar, the good news is that you can use technology to improve your processes. Many of the chores mentioned above are necessary to control costs when trading in foreign currencies. One must distinguish between 2 types of costs: foreign exchange transaction costs and FX gains and losses due to changes in exchange rates. Many businesses are familiar with the concept of FX transaction costs and rightly focus on the ways to reduce them. Very few, however, understand the second type of FX costs, even though it can, in many cases, be several times bigger than the transaction costs. To make things worse, most accounting systems combine transaction costs with actual FX market gains and losses, making it difficult for most to understand the proper drivers at work here. What are FX transaction costs? Most financial service providers charge an FX conversion spread with varying degrees of transparency. The conversion spread is a fee charged as a percentage of the currency that must be exchanged. For instance, if the prevailing market rate to purchase euros is €1.20 for every pound sterling, it would cost a bank £1,000 to purchase €1,200. But the rate a bank would quote its customers would be slightly worse. For example, €1.1764 for every pound. This means that a 2% foreign exchange spread is applied to the market rate, and it costs the client £1,020 to purchase the same amount of euros. Here, £20 is the bank's foreign exchange fee and thus a cost for the business. Standard exchange fees levied by Barclays, NatWest, Lloyds and other mainstream UK banks often exceed 2%. If a business exchanges tens of thousands of pounds sterling for foreign payments with a bank, it may be paying hundreds of pounds in hidden charges. Now let's look at FX gains and losses. Most cross-border trade remains business to business, and over 60% of such transactions in Western Europe are made on open account terms. In this arrangement, the buyer is obliged to pay the seller a pre-agreed number of days after being invoiced. While foreign invoices are outstanding, FX exchange rates can move freely, driven by numerous factors, from monetary policies to foreign investors' appetites and trade imbalances between countries, to name a few. As these rates fluctuate, so does the value of foreign payables or receivables. As a result, most small businesses often struggle to quantify the true costs of doing business in foreign currencies. This also means businesses trading in foreign currencies must absorb exchange rate fluctuations from when orders or invoices in foreign currency are booked until their payment is executed. For example, a British buyer paying a French supplier could suffer unnecessary costs if the euro appreciates against the pound sterling between an order being placed and the time it is paid for. These costs can accumulate and, in a bad year, affect the business's profitability and free cash flows. If the impact of such currency fluctuations is material enough, it must be reported as foreign exchange gains and losses in an income statement. According to a recent study by the British Business Bank, only 4% of SME exporters in the UK manage their exposures to currency fluctuations. Yet when asked about the costs that prevent them from trading more with suppliers and buyers overseas, foreign currencies come as a top 5 barrier for UK exporters. Despite the widespread business desire to trade internationally in the home currency, it is of course impossible for any financial institution to offer this service. However, a small business with a simple setup can achieve the next best outcome within a few simple steps. Every time a business receives a new order or an invoice, these future cash flows can immediately be locked into fixed future amounts in its home currency with an exchange rate that is guaranteed in advance. That exchange rate is used to make the actual payment when it is due. This approach reduces the uncertainty of foreign currency costs and enables businesses to manage their accounts and liquidity in a single currency. Where a business has only a handful of foreign transactions in any given period, the above approach can be implemented with the support of any competent currency specialist firm or a payments fintech. In most cases, pre-booking exchange rates has to be achieved manually over the phone or on a clunky website, but it can be practicable where only a few bills need to be paid each month. However, if the business processes many transactions, system integration and automation technologies are essential to help keep currency management simple. Combined with robust payment automation, systems such as HedgeFlows can integrate with existing accounting systems and manage many invoices in multiple currencies with ease and confidence. The bottom line is that creating a streamlined process for global payments and a robust framework for managing currency costs can create a strong foundation for scalable financial processes and support business growth. Together with using appropriate payment methods as well as automation tools that can help you streamline your workflows and protect from fraud and manual errors, technology can help even small startups manage their international finances as well as, and sometimes better than, their larger peers. Thank you for listening to this module. If you would like to find out more about more formal FX risk management techniques, please find one of our next training modules.